Here's a suggestion for all you long-term investors. When stock market is volatile, grab a bag of chips, park yourself on a nice comfy couch, and watch some Netflix. On a more serious note, let's talk about do's and don'ts when it comes to stock market volatility. What's happening, everyone? Welcome to Think Finance. My name is Raj, and on this channel, I talk about personal finance, investment ideas, money management tips, and everything that impacts our money. Okay, so we are all worried about our money, our portfolio, and retirement accounts. September is turning out to be a nightmare when it comes to stocks. Markets are down approximately 9% of the highs, and everyday swings can be stressful. If you thought September was awful, get ready for a volatile October. With no new stimulus, no major development with the vaccine, rising US-China friction, and election jitters, you should not get too excited with the bounce we saw in last 2 days. Indeed, history suggests October is one of the most volatile months for the US stock market. Does this mean you should be stressed and maybe consider selling a bit and go cash? Let's step back a bit and understand that market rallies and corrections are part of the economic business cycle. If you're a long-term investor, you will face these moves in the market a number of times. Over time, however, you will be fine. Indeed, on an average, market returns 7 to 8% annually. Let's talk about how to manage volatility, assuming you are a long-term investor. Number one, don't get overwhelmed by the noise. When markets are volatile, you will hear a lot of reasons on social media and TV why this is bad and why we are headed down. Somehow, analysts find ways to justify market drops and corrections, and a lot of times they are right. On Friday last week, most of the analysts on CNBC's show Fast Money talked about how we are headed for a 20% drop in the market. Indeed, one of the analysts bought protection to hedge against the drop, which he believes is coming as early as next week. As a long-term investor, you should treat this as noise and stop looking at your account values. Avoid any panic buying or selling, which brings me to my next point. Don't jump in and out of the market. Let's say you think market is going to tank further and you decide to sell everything and go cash. I know at least 2 of my friends did that during the COVID drop. Now let's go further and assume market does tank and now you feel like a genius, which is great. The problem is it is so difficult to decide when to get back in. You really want to avoid jumping in and out. Here is a survey done by an asset management company. If you decide to go cash and end up missing some of the best days of market recovery, in the long term, you will lose money. Again, going back to my original argument, you will never know when it is time to come back in the market. Indeed, most investors end up buying stocks at the highs, which eventually hurts their portfolio. Here are some of the things you want to do as a long-term investor. Number one, stay the course. If you're a long-term investor, I'm guessing you have a plan. You are probably putting new money to work weekly or monthly. Stick with it, especially when stocks drop. You buying stocks cheaper, which is bringing down your dollar cost average. And if you have planned this right, you have this automated, meaning every month money gets withdrawn from your checking account automatically and gets invested, keeping emotions out of investing. My platform of choice to automate my investing is M1 Finance. Link in the description if you plan to open a new account. Number 2, cash. Every good investment plan should have some cash set aside. My target is 15%. At any point in time, I have 15% of my portfolio in cash. Having cash in your back pocket will allow you to buy parabolic dips like we had one in March, which brings me to my next point, dollar cost averaging. History suggests when markets drop big, they tend to come back roaring following years. The most recent example was in March 2020. If you had put new money to work or your 15% cash to work in March, your ROI in S&P as of today could have been 33%. It gets better with NASDAQ, where your ROI could have been 49%. This is after accounting for the September dip. The problem with this strategy is you never know what the right time is to deploy new cash. If you wait for the so-called bottom, well, good luck. Fishing for bottom is silly. Personally, I use thresholds. I put in new money at every 10% drop in the market from the highs. During the March COVID drop, I put in new money when markets dropped 10%, 20%, and at 30%. This was in addition to the monthly contribution I made as part of my investment plan. I also made other changes, but long story short, use the cash to buy the dips. By doing so, you're buying stocks cheaper, which brings down your average cost per share. Final point to consider is rebalancing. If you believe markets are in for a bumpy ride in the medium term and you have made some decent chunk and think it makes sense to protect gains, you might want to consider rebalancing, meaning moving money from riskier securities into more safer bets. I rebalanced my portfolio at the end of October when tech was on a tear and moves felt way too parabolic. I moved some money from overweight leverage ETFs into non-leverage positions. There are other hedging strategies you can apply to protect your portfolio. More on hedging in this video. Let's summarize this. Avoid the daily noise. Avoid panic buying and selling. Instead, have a systematic approach where you stick with your investment plan. Use cash to buy the dips at regular intervals and rebalance or hedge your portfolio as needed. Thanks for tuning in. Make sure to hit that like button. And if you like this content, go ahead and subscribe. Until next time, peace.